Good afternoon, everyone. We'll begin shortly. All right, everyone, good evening. My clock says 6 o'clock, and I'm sure you know I like to begin on time. I trust everyone had an enjoyable weekend, and you have handed in my homework before 6 p.m. today. I'll check my email in a moment or two. All right, any questions about homework before we begin? I take that as a no. Okay, so last class, we began talking about the big ideas in economics. And we had begun our conversation. We said there's three big things that we're going to focus on when we're talking about looking at the economy as a whole. We're talking about gross domestic product, unemployment, and inflation. And we had gone on to define gross domestic product is the production of final goods and services in the economy in a given period, usually a year. And we said there are three ways of measuring gross domestic product, or GDP. We said we can use the expenditure approach, which measures the value of goods and services produced, inventory, so it measures the value of the real stuff. The income approach, which measures the value of the money earned from the production and sale of that stuff, and the value-added approach. And we had taken a look last time at the value-added approach to calculating GDP, how that should give us the same result as the income or the expenditure approach. What we wanted to begin to do today is actually put some flesh on those bones, to actually put some numbers to those calculations. So what we want to do, we want to begin by trying to calculate a GDP for a nominal country using the expenditure approach, then see how that is similar and different from the income approach and how they should generate the same numbers. All right, so let's refresh ourselves in terms of our definition of the expenditure approach. We said the expenditure approach measures the dollar value of final goods and services produced or consumed in any given economy whether that production is by households, which we call in consumer or C in our identity, whether that production is by firms or businesses, which we're calling I or investment in our identity, and whether that production is by government, both local and national government, which we're calling G or government purchases in our identity. And then also included in our calculation of GDP is that we must take account for the foreign sector, exports and imports. So in calculating gross domestic product expenditure approach, we look at the household consumption, C, business consumption, which we're calling I or investment, government purchases or government consumption, which we're calling G, exports, which is X, and imports, which is M. All right. Now, it is important for us to note that exports minus imports, which we call net exports, can be both a positive or a negative number. If you export more than you import, then net exports will be a positive number because X is bigger than M. But if you import, like certainly how we do in the Bahamas, we import more than we export, then your net exports will be a negative number. And so when you do have to bear that in mind when you're calculating the expenditure approach, and that's certainly a reason why you would want to make sure you clear that export minus import brackets first. So you're then able to determine whether that value, net exports, is a positive or negative number. Okay, so the best way to do this is through an example. So you will get something like this, a set of tables with a set of values. So these are all the numbers that we have gathered from a particular economy. And we would use these numbers to calculate gross domestic product expenditure approach, but also the income approach. So then it's going to be very useful for us to be able to identify which values go into calculation of the expenditure approach and which values go into calculating the income approach. So how do you go about calculating the income approach then? If we say the expenditure approach is that we calculate the values for consumption, investment, government, and net exports, how do we go about calculating the value of GDP using the income approach? So, definitions. The income approach measures the dollar value of income earned from the sale and consumption of final goods and services. Okay. So income approach is all about the money. So if that's the case, then if we said the income approach is just the money we earn from the sale of the goods and services, we should be able, because let's say you have a store. If you say my inventory is worth $100,000, you should, at the end of a sales period, and you've sold your entire inventory, you should have $100,000 in revenues. You should be able to say, I had $100,000 in inventory, I sold $100,000 in inventory, I should have $100,000 in income. It should be an easy step to go from value of inventory to amount of income or revenue. And it is exactly that approach where we're going from the value of inventory, what we're calling the expenditure approach, and the income that we would earn from the sale of those production. So how do we go from what we calculate from the expenditure approach to what we should be expecting in terms of revenue using the income approach? Now, to begin with, we like to say it's a relatively simple matter to move from one measure of GDP to the other. Right? First of all, we would need to calculate what's called gross national product, or GNP. And we're defining gross national product as the dollar value of final goods and services produced in a given period, usually a year, but it's by all the nationals of our country. So when we're trying to measure gross national product, we're not just measuring the goods and services produced in the Bahamas, we're measuring the final goods and services produced by Bahamians wherever they happen to be residing. So we're trying to measure the dollar value of final goods and services produced by nationals of that country. And to get that figure, we take our GDP figure and we add what is called net income earned abroad. This is money by domestic residents, Bahamians, who happen to be living outside of the country. And we add that to our GDP, and it gives us what is called our GNP, or gross national product. Right? So when we're looking at our table of statistics, we're looking at we're looking to find in that table something that says this is the money earned by Bahamians living outside of the Bahamas, net income earned abroad. All right. So now we have a figure for what we call GNP, earnings by nationals. Then we want what is called net national product. And to get net national product, we start off with our gross national product, and we deduct or we subtract from that depreciation. Right? And depreciation, we know we've defined as normal wear and tear of your country's capital stock. So we start off with GDP, which is all the production in the country. Then we added the production by Bahamians outside of the country to give us a GNP. Then we subtract from that value the decline in the value of our fixed assets, which is an accounting type thing called depreciation. It just means that things wear and tear over time. And if you're managing a good business, or if you're managing a good country, you take into account the fact that your capital goods are going to depreciate. So you put aside money over time to replace these things when they eventually wear out. And there's usually an accounting standard, a fixed value in percentage terms, in which you mark down the value or depreciation of that capital stock. So now you end up with net national product. Now, the next step then is to calculate national income. And we will look at two ways of calculating national income. Right? One way is that you can take that net national product that we just calculated, and we subtract from that what is called indirect taxes. Indirect taxes are things like sales tax, gas tax, imported duties, value-added tax. These are, when we say indirect taxes, we mean this is money that's not coming directly out of your paycheck. All right. An indirect tax is tax that you only incur if you consume a certain product or service. So if you buy something from the store, you pay the tax. You pay the sales tax or the value-added tax. Right? If you don't buy anything, you don't pay any tax. Gas tax. If you don't buy any gas, you don't pay a gas tax. If you don't import anything into the country, you don't pay import duties. Right? So these are indirect taxes. So one way of calculating national income, and you will be actually calculating national income in two separate ways. One way would be to take net national product and subtract from that indirect taxes. And that will give you one calculation for national income. Another means of calculating national income is to add up all the monies earned in an economy by different means. So for example, we would add up employee compensation, which is not just salaries, but any kind of compensation you get from your employer. So you have employee compensation, and you add to that what is called proprietor's income. You own a business, this is the money you make from your business, proprietor's income. Then it's rents. You have apartments, condos, duplexes, triplexes, you have stuff on rent, income earned from those rental properties. You add, obviously, counts as part of the income of the country. Interest income, whether it's interest on savings or interest on bonds or any kind of investments, all right, that will come into this category. So all of this, of course, is money coming in, national income. You also include in that corporate profits. All right. So two ways of calculating national income: net national product minus indirect taxes, or you add up all the streams of income that is being generated in the economy. Now, both methodologies should generate the exact same answer. However, for our purposes, whether it's in homework or an exam, I will make sure that when I actually calculate net national product in two different ways, you're going to get two answers. Because what I don't want you to do is calculate it in using one methodology and assume that that's the same answer that will apply for the second methodology. I've been down that road before. So national income, two ways to calculate national income. What else will you be asked to calculate? Given the data set that's going to be provided, you'll be asked to calculate personal income. And personal income we're defining as the sum of all incomes actually received by individuals or households during a given period, including unearned transfers. Remember, we talked about transfers earlier, and we said we don't count transfers as part of GDP for the expenditure approach. Here we're adding in unearned transfers, but we are excluding corporate profits withheld rather than distributed as dividends. Okay. Here's what we're saying. We're talking about your monies now, your personal income. So it's all the money that you got from whether you own a business, in this case, you're getting proprietor's income, whether you have some apartments on rent where you're getting rents, whether you have a savings account, fixed deposit, or you are investing in some bonds where you're getting interest. All right. All of those would count as part of your personal income. All right. We will also include in that calculation for your personal income any unearned transfers, any, say, national insurance benefits. They would count as unearned transfers. But as far as you're concerned, that's still income coming to you. All right. So we will count as part of your as part of your personal income. Which we won't include as part of your personal income would be when a company that you've invested in says, instead of handing out the profits as dividends, we're going to hang on to this profit and use it to build the company. Right? So that will be corporate profits withheld rather than distributed as dividends. Right? Obviously, we can't count it as part of your personal income because it's not hitting your bank account. Right? So when we talk about personal income, we talk about all the monies that you would earn plus unearned transfers, and we will exclude dividends that are withheld. And you see that the calculation for that PI equals NII plus transfers minus retained profits. And finally, you'll be asked to calculate disposable personal income. So disposable personal income, it's not just the amount of money that households have available. It is the amount of money that households have available for spending and or for saving after government get its cut, after income taxes have been accounted for. So disposable personal income is all the money you get getting in, and then you take out what government is taking out in income taxes. So disposable personal income, or DPI, is your personal income minus income taxes. So then, what are some of the things that we won't capture when we calculate GDP, whether we're talking the expenditure approach or the income approach? So these are kind of things that going on in our economy that we know are going on, but the system is not set up as such to be able to calculate or capture these type of activities. All right. The first is home businesses. You don't have a business license, but you have a little home business going on. Right. Now, it could be, back in the day when people used to sell Amway or tuck away containers, it was a home business. You have people who have converted their garage into, close it off and turn it into a little beauty salon, or what we call bush mechanics, roadside fruit vendors. These are all people who have a business and they're making money and they're buying and selling stuff, but we don't have the ability, given the way we calculate GDP, to be able to capture what's going on in these countries, these businesses. What's also true about these businesses is that they almost always don't pay national insurance. Right? So we can't even track them using national insurance payments, whether or not they have employees. Right? So that's the first category of businesses that we just simply cannot capture within GDP. Also, of course, there is the underground economy. Whether you're talking about all the illegal stuff, right, whether you're talking the corruption, all right, we just simply can't capture that. And we also are unable to capture things like unreported tips. You work in a hotel or some other tourist type facility, or even someplace where they pay tips. And if they're tipping you in cash and not just the 15% added to the bill, that's a whole different story. We're talking about the tip that's left on the table. Right? There is no way for us to know what that is. So that doesn't get captured when we're counting GDP. And finally, it's difficult, but economists are working on it now to capture environmental changes within GDP. Right? Whether you're talking about large-scale environmental changes like global warming, or whether you're talking more local changes in the environment. Right? One of the biggest difficulties for us, say in the Bahamas, is calculating the impact of hurricanes on the environment, not just on the economy, on the environment. How much environmental damage has been done? How do you quantify that? That is one of the difficulties. We can always measure in the economic impact in terms of, let's say, homes destroyed or businesses destroyed or farms destroyed. We can estimate that fairly well, and we do. The difficulty is that how do you measure the value of change in environment? We're not there yet. But economists around the world continue to work on it, and I'm sure there's progress being made, and we will know eventually. Okay, so let's try a hand at it as an example, because you will get this as a homework on Wednesday. Right? You get a table like this. Right? Obviously not these exact numbers. And this table provides information on this economy. We see that net income earned abroad is 100,000, income taxes 850,000, interest payments is 2.8 million, rental income is 1.75 million, dividends is 300,000, imports is 200,000, proprietors income is 1.9 million, transfers is 250,000, depreciation is 300,000, consumption is 10 million, exports is 700,000, profits is 2.4 million, investments is 3.5 million, government spending is 8 million, salaries is 12.75 million, sales tax is 200,000, and retained profit is $1 million. All right, here's the numbers you've been provided, and the question would be calculate GDP using the expenditure approach, calculate GNP, NNP, calculate national income using both approaches, calculate personal income, and calculate disposable personal income. So let's walk our way through this example so that you have this in your notes. So when you tackle the homework come Wednesday, the first thing we're asked to calculate is GDP. All right, and we know that GDP is C plus I plus G plus X minus M. All right, so let's go back to our table, and we're looking for C plus I plus G plus X minus M. And we see consumption, C is 10 million. Investment is 3.5 million. I'm looking at the column on the right. Government spending is 8 million. All right, so that's 10 plus 3.5 plus 8. That's 21.5 if you counting. Somebody calculate, keep track of your numbers, please. And then you have exports minus imports. We have exports. Where do we have exports? Exports is 700,000. And imports is 200,000. So that's 700 minus 200. So that's a positive 500,000. So we have 10 million for GDP, 3.5 million, 10 million for consumption, 3.5 for investment, 8 million for government spending or government purchases, 700,000 for exports, and 200,000 for imports. Did anybody get a number other than 22 billion? Yes? No? Well, in that case, then what about GNP? We said GNP, if we go back, so GNP is GDP plus net income earned abroad. GDP plus net income earned abroad. And we said GDP is 22 billion, net income earned abroad is 100. That should be million, not billion. I don't see why it's billion, it's millions. So 22 million minus 100,000, sorry, plus 100,000 is 22.1 million, not billion. All right, so that gives us GNP. Then our next step is to calculate net national product, NNP. And according to our notes, NNP is GNP minus depreciation. If we've done our numbers right, and we have GNP of 22.1 million, and if we look at depreciation, we need to go to our table. What's depreciation? We see depreciation in our table of 300,000. So it's 22.1 million minus 300,000. 22.1 minus 0.3 gives me 22.8. And since so far I'm not hearing any screams of complaints, I'm assuming my numbers are right.
Mr. Merit.
Yes, ma'am.
Where do I find X minus M? Where is that?
Okay, so let's go to here's our table, right? And you see at the bottom of the table, our expenditure approach for calculating GDP, right? And it says GDP is C plus I plus G plus X minus M, where X, if we go further in our notes, oh, sorry, going the wrong direction, where X is exports.
Oh, okay.
And M is imports. So when you're looking at your table, then you're looking for exports. In this case, it's the table on the right, which is 700,000.
Right.
Imports, which is on the left, which is 200,000.
Okay, thank you.
No problem. Okay, so that allows us to calculate net national product, GNP minus depreciation, and we ended up with a value of 21.8 million. Now, we were asked to calculate national income. And we said there are two approaches. Now, it may very well be that when you get a table like this, you don't have enough information on the table to calculate both approaches. All right. In that case, the question won't ask you to calculate both approaches. It would just say calculate national income. And it's up to you to decide, okay, which approach I can use to calculate national income, depending on what information is being given to me in the table. But in this case, let us see. Right? One approach to calculating national income is you start off with net national product, which you would have calculated previously, and you subtract from that indirect taxes. So you need to go back to your table and see, do we have something in there that we can call indirect taxes? Because you probably won't see the words indirect taxes in your table. You will see some kind of tax in your table, and you'll have to determine whether if in fact it counts as an indirect tax. And remember what we call indirect taxes. Indirect taxes, we said, would be something like a sales tax, a gas tax, import duties, or value-added tax. Some kind of tax that is not coming directly from your salary. All right, so let's look at the table and see what we can find. And if you would notice on the right-hand column, second from the bottom, you will see we have a sales tax. All right. Clearly, a sales tax is an indirect tax because if you don't buy the item, you don't have to pay the tax. So it's an indirect tax. So that sales tax of 200,000. So let's see, we slip that into our calculation. So our first approach, we can certainly use our first approach to net national product. Our first approach to national income. We calculated net national product before, and we subtract from that our sales tax of 200,000, and we end up with a total of 21.6 million for our first calculation for national income. Now, here's the thing, ladies and gentlemen. You would have noticed that each of these calculations depend on the previous calculation, which means if you got your calculation for GDP wrong in question 1, your calculation for GNP is going to be wrong, your calculation for NNP is going to be wrong, and your calculation for the first approach to national income is also going to be wrong, because they all depend on your previous answer. Just in case persons hadn't noticed, I thought I would bring that to your attention. Something else to worry about. But there is some good news. I am not without mercy. So let's assume for a moment that you miscalculated GDP using the expenditure approach. In that case, I would grade that answer wrong. You get 0 points for it. However, if you use that erroneous answer, but you did all the subsequent calculations correctly using that erroneous answer, I'll have pity on you. But because it will be clear to me that you know how to do the calculation. Yeah. But that first incorrect answer has precipitated through all of the subsequent answers. That being said, shall we move on? The second approach to calculating national income is to add up all the monies. So we said, let's go up.
Sorry, I have a question.
By all means, and this is
Fabian.
Hi, yes, Fabian.
Okay, for the one NNP, question number 4, you said indirect taxes minus sales tax.
No, indirect tax. Actually, that sales tax is an example of an indirect tax.
Oh, okay, so it's not a part of the formula. Okay.
Right. So it's okay. Let me fix that. Just in case I send these notes to you, and that should be in brackets.
Okay.
All right. That should be in brackets. So that should be this. All right. Does that help? Okay, so let's add up the monies. According to our notes, employees and national income using this secular approach, you add up employees' compensation plus proprietors' income plus rent plus interest plus corporate profits and anything else that counts as money coming directly to you. All right, so let's see. Do we have in our table, you see the third item down, interest payment, so that would count. Rental income, that would count. Dividends, that would count. Proprietor's income, that would count. What about transfers?
Would that be a form of investment?
No, transfers is money coming from NIB. You had a baby, NIB gives you money. You lose your job, NIB gives you money. You got old, NIB gives you money.
Compensation?
I guess it's a form of compensation, but it's technically is called transfers because you're getting money for doing nothing. I mean, granted, having a baby is not nothing, but the government is not getting anything out of the deal. That's why it's a transfer. It's not a payment for a product or service. Right? But certainly we would include that. So let's see. We include, sorry, we would not include that because we use transfers as part of our calculation later on. So here's our employee compensation, which is 12.75, plus proprietor's income, which is 1.9, plus rent, which is 1.75, plus interest, which is 2.8, plus corporate profit is 2.4. I'm certain you're going to test my numbers on it, make sure I got them right, and that adds up to 21.6. So you would notice in this particular case, whether you're using the first or the second approach, you come up with the same answer. Because we're supposed to be calculating the same thing. We're supposed to be calculating national income. And whether we're using the first approach or second approach, we're still measuring the same amount of money coming into the economy and coming into the pocketbooks of our people, whether it's individuals or businesses, national income. Right. So it should give us the same answer. And in this particular case, it does. But as I've said, when I give you homework on Wednesday, and I ask you to calculate the two approaches to national income, you cannot, you should not, you must not assume that just because you got 21.6 for the first, is going to be 21.6 for the second. Because I'm going to make sure that it is not the same. All right. Although technically it's supposed to be the same, I'm going to make sure it's not the same just for our purposes. But in the real world, both approaches are going to yield the exact same amount. Then you
said, sorry, and you said we didn't include the transfers because we're using it in the next one.
Okay, look down at number 6.
Yeah, I see number 6.
And you see transfers.
Mm-hmm.
That's where transfers will come in.
Okay.
Right. And that is what we're talking about right now, personal income. Personal income is national income. And the reason why we don't include transfers when we are calculating national income, because national income, all the monies that we are earning is monies that we have earned. Yeah, we are being compensated for stuff that we have done. Employee compensation, I work, I got paid. Proprietor's income, I sell a product or service, I got paid. Rental income, I provide someplace for somebody to live, I get paid. Interest income, I let some people use my money, I get paid. Corporate profits, same thing. All right, I get paid. So here, for when we're talking national income, we're talking about, sort of, we do a product or service, we get money. We provide products. So there's two sides of this transaction. But with transfers, there's only one side of the transaction. You're getting money, so you're receiving income, but you are not doing anything to earn that income. That's why transfers are very often you see referred to as unearned income. All right. So for personal income, it is all the earned income, what we're calling national income, plus the unearned income. Right. And the unearned income is your transfers minus any monies that you should have gotten as part of your profits from the company that you're investing in, but the company decided they're going to hold on to that money to grow the business. All right. So personal income is national income plus transfers minus retained profits. And that gives you, so if our numbers are correct, it's 21, and we always solve the brackets first. And in the brackets, we have transfers minus retained profits. So we solve that first. Right? Even if that turns out to be a negative number, so be it, but we solve that first. And in this case, it does turn out to be a negative number because we have transfers is 0.25 or 250,000, and retained profits is 1 million. So the difference is 850,000. All right. So we ended with 21.6 plus the difference, which is a negative number in this case, and we ended with 20.85. And our final calculation is we're asked to calculate disposable personal income, DPI. Right? This is the money that you get to spend and or save. Disposable personal income is all the money you earned. So all your earned income plus your unearned income minus the money that a company is keeping to grow the business. All right. So that's your personal income minus your income taxes. Now, your income taxes is different from your sales tax or indirect tax because an income tax is money coming straight out of your salary. Think of this like national insurance payment. Right? It comes straight out of your salary before you get paid, they get paid. Right? It's an income tax, it's a tax on your income. Despite, what term we use for it, it's an income tax. So you should be able to follow this example to answer at least the first half of your homework question that you will get. I probably will send it probably Wednesday morning, but certainly before class. So I give you an opportunity to take a peek at it before class begins on Wednesday, which is questionable because, as you know, I am out of the country, and we'll have to see just where I am on Wednesday. But I will, if there's any issues, I will send everybody an email, hopefully well ahead of time, so that you don't show up for class expecting to see me and you don't. Okay. Any questions before we move on? So that pretty much wraps up our initial foray into our discussion of gross domestic product, GDP. And all it's doing for us is really building our understanding of GDP, gross domestic product, output in our country and our economy, and the various ways of calculating it. And that's really setting us up for our policy discussions and conversations and arguments that we're going to have probably beginning next week, if not the week after next. It will certainly, it will take up the second half of our semester will be all involved in policy conversations. All right. So once we get past the midterm exam, and I'm tentatively scheduling the midterm exam for a week from Wednesday. We'll talk about it on Wednesday. We'll talk about it the following Monday. Okay. So before we get too sidetracked into that, we want to now begin talking about employment. Right? Jobs for our people, quote unquote. Right? And a lot of this is really about definitions, making sure we understand the various types of unemployment, how we calculate that so that we can then use that understanding for a more in-depth policy discussion of how we address unemployment issues when we begin looking at those in the second half of the semester. All right. So let's get some very precise definition of unemployment. Because first of all, too many people think unemployment is just somebody who don't have a job. Right? But economically, right, when we say unemployment, we're talking about the total number of persons who currently do not have a job, yes. either full-time or part-time. So you can't be working at all. But, and here's the big but, you have to have been actively looking for a job within the last month, within the last 30 days. All right. For the Department of Statistics to consider you as unemployed, hang on a second, folks. All right, so back to our conversation. You, as far as the Department of Statistics is concerned, and they're the official statistical agency, they're the ones who say whether you're employed or not. So they come around and they do the surveys and they ask, for example, how many adults you have in the house, people over the age of 18, out of school, right? Fine. It's me, the wife, and 3 kids, all over the age of 18. And they'll ask, how many of y'all are working? Well, me and the wife are working. Right? They don't stop there and then just say, okay, 2 people working, 3 people unemployed. No, they ask, okay, the 3 who are not working, how long have they been out of work? Longer than 30 days? Okay. When's the last time they went looking for a job? And by looking, I don't mean driving around the street and coming back home, popping up to your friend, hanging out for a while and coming back. We're talking about fill out an application and going on an interview, right? Actively look for a job, right? If they have not done that within the past 30 days, they are not considered unemployed, all right? They are not considered part of the workforce. Not to put too fine a point on it, they're considered bums, or that, okay, that's not the technical term, yeah, but that's what it is, all right? They do not count as part of the workforce. They don't count as being unemployed. They're bums. Right. You have to have been looking for work in the past 30 days to be considered unemployed. You also have to not be working either full-time or part-time. If you have one little job, even though you want a big-time job, but you make it do this one little job, you're working. Right. All right. So that's our definition of unemployment. Whether you argue about it, agree with it or not, Department of Statistics, who is the official statistical agency, it makes these determinations. That's unemployment. Sorry. Now, we also need to calculate what's called the unemployment rate. And the unemployment rate is the percentage of the labor force that is currently unemployed. So the calculation is just the unemployed divided by the labor force. So it's the total number of persons unemployed divided by the total number of persons in the labor force. Well, in that case, then we need to define what we mean by labor force. The labor force is everybody in the country who is employed and unemployed. The labor force is usually, they look at individuals between the age of 18 and 65. 18 because mandatory, you're supposed to be in school. And over 65, you're supposed to be retiring with your foot up. So the labor force, they tend to count persons, whether they're employed or unemployed, between the ages of 18 and 65. What else? Then there's what's called the labor force participation rate. All right. So you look at the total number of persons who are employed and unemployed between 18 and 65, and you divide that by the total population. All right. So let's say you have in the Bahamas, you have a population of 400,000. All right. And between 18 and 65, you have 300,000 people between 18 and 65. So that's 300,000 divided by 400,000. That gives you a labor force participation rate of 75% or 0.75. So that's how we calculate labor force participation rate. Then we want to define what we mean as a discouraged worker. So back to our example, where this Department of Statistics worker came to the house, 2 adults and 3 grown children. The 2 parents are working, grown children are not. And the Department of Statistics worker is discussing the kids. All right. And they said, yeah, we have actually looked for work in the past, maybe a couple of months ago, at least once in the last 90 days. 90 days is 3 months, by the way. So they did actually look for work. So Daddy's saying, yeah, they actually looked for work in the last 90 days. Yeah, but things suck out there. And they kind of gave up. They would be counted as what's called discouraged workers. Right? They're not unemployed anymore. All right. Sorry, they're not unemployed anymore. They're not part of the labor force. All right. And we don't want to call them bums. So we call them discouraged workers. You've looked for a job in the recent past, at least once in the last 90 days, but you give up because, ain't nothing happening. And then what we have is what's called underemployed. Underemployed is someone who's working part-time, but really, really would prefer working full-time. Or someone who has a job that is well below their actual capabilities, not what they think in their heads. All right. So this is somebody who went away to school, get a big fancy degree, but come back, can't find a job in their field, so they settle for something well below their capabilities. All right. That person is considered underemployed. Underemployed is not you thinking you could run the company. All right. That's just delusional. All right. All right. So those are definitions that we certainly going to want to be able to familiarize ourselves with and be able to recognize if we see them, and to be able to use those calculations for those various types of unemployment. Now, there are 3 specific types of unemployment that we certainly want to spend a lot more time and attention on. The first is called cyclical unemployment. Cyclical unemployment is the type of unemployment that accompanies fluctuations in the economy, fluctuation in real GDP. These are people who, Lord, they ain't got much education. They ain't got much experience. They ain't got much skills. All right. All really, if they are male, they, at best you can say they have a strong back. Yeah. If they're female, they say at least she ain't pregnant. All right. These people with very little prospects. These are often referred to as LIFO, last in, first out. You're only ever going to consider hiring these people when things are going so good that you just need an extra pair of hands. Right? If you see these guys in the construction business where their only job is to lift, tote, and carry, they're not asking them to measure anything or hammer anything. No. Take that wheelbarrow and bring a load of sand over here. Right. You also see this if they're females in a lot of the stores downtown. All right. You don't need much or nothing to do those kind of jobs. But things will have to be going really good for you to hire these people. It also means that the minute things buck up, I know that's not a good mathematical or economical term, but the minute things slow down, these are the first person you get rid of because they really don't have a great amount of value to you. So they're the last people in, the last people you hire, but the first people you're going to let go. Last in, first out. These are persons only hired in terms of exceptional economic growth and expansion, and persons usually made redundant at the first sign of an economic downturn. All right, so cyclical unemployment rate, when you have to calculate it, it's cyclical unemployed divided by the labor force. So the first type of unemployment we talk about is cyclical unemployment. Unemployment that accompanies fluctuations in the real economy. Then we have what is called frictional unemployment. These people we don't worry too much about because this is the type of employment naturally occurring during normal workings of the economy. You know, these are the people who are between jobs. You know, usually you have to give 30 days notice. So once you've given your notice, technically, you have resigned from that company, but you haven't taken up your new job as yet, but you have a new job waiting for you. So, you know, in less than, you may be technically out of work for less than 30 days. All right, so people are in a process of changing jobs, but also if you're moving between cities or you're moving between islands, normally, yeah, say you're moving from Nassau to Freeport or Freeport to Nassau, your new employer will give you a period of time to get relocated before you start work. All right, so you've left your old job, but you haven't started your new job yet because they're giving you enough time to get settled, find someplace to live, et cetera, et cetera, et cetera. All right, so we don't worry about these people. All right, technically, they are unemployed, but that's a very, very temporary situation. So we call these people frictionally unemployed. This type of unemployment naturally occurs during the normal workings of an economy. And to calculate the frictional unemployment rate, we start off with those persons who are frictionally unemployed divided by the labor force. Everything is divided by the labor force. So we want to know what proportion of the labor force is frictionally unemployed. And lastly, we have what is called structural unemployment. This is hardcore unemployment. This is a type of unemployment where you could be out of a job for 10 years because there's a mismatch between the jobs available and the skills of workers. For you to get another job, people need additional education or training, go back to school, something. Otherwise, ain't gonna happen. All right. Think of it, let's say you were working in a hotel as housekeeper many years. You are a wonderful housekeeper, great skills. All right, your hotel closed down. All you know is housekeeping. If there's no other housekeeping jobs available, what do you do? Hardcore unemployment. These are all also the kind of people who have never, ever had a job. All right. You've been hustling your entire life. You don't know what it is to actually have to work. Yeah. So for you to find a job now, you know, you need training, you need to go back to school, you need BTVI, you need something. Structural unemployment, hardcore unemployment. And to calculate this rate is the number of persons who are structurally unemployed divided by the labor force. What proportion of the labor force is considered structurally unemployed? So those are the three types of unemployment: cyclical unemployment, frictional unemployment, and structural unemployment. Okay, so how would we put those to use in the second half of your homework coming this Wednesday? So the first half would be calculating your whole GDP stuff. The second half would be calculating your employment stuff. So you will be given a word problem just like this, well, in concept. All right. An African nation, in this case called West Lesotho, they have a population of 5.5 million persons, of which 4.8 million are between the age of 18 and 65 and considered part of the labor force. Currently, there are 1 million persons unemployed, but who continue to seek employment in the last 30 days. Of this total, some 700,000 persons, so out of the million, that's what it means, of this total, out of 1 million, 700,000 are unemployed because of a downturn in the economy, 200,000 are moving between cities and haven't yet taken up their new positions, and 100,000 have been advised that without further education or training, their hopes for any employment are slim. A further 250,000 have given up and are simply awaiting better economic times. And there are also some 300,000 persons working part-time, but who would like to work full-time if they were able. So you'll be given a scenario very similar to this. And you'll also be given these 7 questions. Determine for the government of West Lesotho, what's the labor force participation rate? What's the unemployment rate? What's the cyclical unemployment rate? What's the frictional unemployment rate? What's the structural unemployment rate? What's the rate of discouraged workers? And what is the underemployment rate? Right. So you'll be given this scenario with these numbers in them, well, similar numbers, and you're asked to answer those 7 questions. I'll walk you through this example. So we're gonna start off with question says labor force participation rate. And if we go back, labor force participation rate is labor force divided by the population. So let's go to our answer, labor force divided by the population. What's our labor force? Our labor force is persons between 18 and 65. And according to our scenario, that is 4.8 million. As you see, it says a population of 5.5 million, and you have 4.8 million between 18 and 65. So our labor force is 4.8, and our population is 5.5. So our labor force, 4.8 million, population of 5.5 million. So what does that give us as a labor force participation rate? Somebody calculate it, please.
%, 87.27%. Is that correct?
Okay, let's start. What did your calculator actually say?
It said 0.872.
What's after the 2?
Oh.
Because you also, you always
Hold on,
want,
let me do it again because I did that already. Times it
right,
by
you always want to go to 4 decimal places just to be safe.
7 is after the 2.
Yeah.
Okay, so 7 is after the 2. So then multiply that by 100%, by 100 to get a percent. And you get 8.73. Because the 27 becomes 3, right?
That's correct.
So 8.73%. Unemployment rate. How do we define our unemployment rate? Our unemployment rate, we said, was unemployed divided by the labor force. All right. Unemployed divided by labor force. How many persons are unemployed? Here's our scenario. Currently, there are 1 million persons unemployed. You see where I'm looking at that? And the population is, sorry, the labor force is 5.5 million. We found it earlier. So then what do we get?
So we're not going to be using the 4,800,000 for labor force.
You're asking or telling me?
I asked it because
You're supposed to be telling me. So let's go back to our notes. And what do our notes say? Our notes say labor force participation rate is, sorry, what are we calculating? Unemployment rate.
correct.
Total number of unemployed divided by labor force. And what did we say our labor force was? Our labor force was 4.8 million.
Right.
Okay. So then this you're saying should be 4 1,800,000.
Yes.
Okay, I agree with you.
Well, why you ain't fix it? Why you ain't have it? Oh, you have to change it ourselves when it's time for us to do the homework. Hey,
Yeah.
oh Jesus.
If
Lord.
you see the numbers is the same for everything.
Mr.
I
Demerit,
thought that was just an error on your behalf. That's all. Okay, thank
It's
you.
up to you to put in the right numbers.
But you have numbers already there.
The same numbers for every answer.
But I didn't see that part. All I know is I taken one at a time. But thank you.
Exactly. Yeah.
Mr. Demerit, this is Lanique Bethel speaking.
Yes, Lanique.
Why did for the last one,
For
how come
number
you
one,
get 8? Yeah, how come you got, maybe it's just me, I don't know, but you got 8.73, but when I timed it, it was
you got
87.
87. You got 87.27.
Yeah, right. That's what it's supposed to be, right?
Yeah, but see, some people
Rounded it off.
tell me it's 8.73.
No, I just asking because when I times it by 100, that's what I.
No, you're right.
Oh, okay.
Yeah.
So you don't want us round it off then?
87.27%. No, do not. I don't know where people first started rounding off stuff from. That's, no, don't round off none of my numbers, please. I like my numbers just the way they is. Right. Here's the thing. Unless you're dealing with money, right, where your answer is in, cents, because there's no such thing as a quarter of a percent, half of a cent. So if your answer is 20, you calculate your answer and it turns out to be $8.27.8. Obviously, you round off to 28 cents. Right. But apart from that, no. If there's ever in doubt for any answer that you have for me, leave it. Do not round it off. All right. Rounding off doesn't help you. It could hurt you, but it never helps you. Did I tell you I don't like rounding off? Maybe you all got the idea. I don't round off my numbers, please. Don't round off my numbers. No, don't round off my numbers. Okay. So, no, it was Lanique. No, answering my unemployment rate question. I followed. No, it wasn't Lanique. See, I can't see who you guys are. Was it Fabian? I can't remember.
Nico?
It was Tamiko? All right.
Yes.
Okay, fine. You told me fix that bottom number.
Right.
So I fixed the bottom number. Now what you got for me?
I got 0.2083.
0.2083. All right, so now convert that to a percent.
I get my times it by 100, so I get 20.83.
Did anyone get a different number? All right, okay, fine. We'll go with Miss Tamiko's answer. All right, so now cyclical unemployment rate. And it's cyclically unemployed divided by the labor force. And Mr. Tamiko tell me fix my labor force again to 4800000. Right?
Yeah.
All right. So now we need how much people is considered cyclically unemployed. Let's go to our scenario. How many people are considered cyclically unemployed? So how do we define people who are cyclically unemployed? Let's go to our discussion. These are last and first out. No job, no experience, no education, no experience. Last people we can hire, first people we can fire. We only hire them things when things going good in the economy. All right, so we're looking for people who are affected by when the economy does stuff. All right, fine. What do we got?
100,000.
100,000.
I think it's supposed to be 100,000. No?
100,000 have been advised that unless they go back to school, ain't nothing happening for them.
I
I don't
think
feel like the
missing is
economy-
0.
Sorry?
Yeah, missing a 0 at the end, but I
No.
think it's supposed to be 100.
Yeah, okay, we missing a 0, but that ain't really the problem, is it? Yeah, these are the people who, they gotta go back to school. These gotta be hardcore unemployment, right? Because they've been advised that unless they get some more education or some training, their hope for any kind of job is slim. So it's not because the economy is going up or going down. These people just, whatever skills they have, nobody wants. But we're looking for people who have lost their job because the economy turned a little sour.
Or that's 700,000 then.
Let's see, 700,000 persons are unemployed. Yes, because of a downturn in the economy. See? All right, if that's the case, then, so we make our cyclically unemployed 700,000. And since Mr. Miko is doing all the calculations, what do we get? Oops, that's wrong.
I get 0.1458.
0.1458. And when you multiply that by 100,
I got 14.58%.
did anybody get a different number? Not that I don't trust, but No?
We could do a second opinion, that's fine.
Sorry?
I said we could do a second opinion, that's fine.
Oh, okay. Well,
But that's what I got. I
I'm
know
sure
this one-
somebody would have made some noise if they got a different answer. Okay, fine. Now you have frictional unemployment rate. So first of all, let me fix that bottom number because you all said that I can't leave that like that. So the labor force, we like to put on the bottom. Oops, where are we? Okay, that looks right. All right, so frictionally unemployed. How do we define these kind of people? Frictional unemployment is this type of unemployment naturally because during the normal works of economy, people moving between jobs, moving between cities, moving between islands. All right, so then let's go to our scenario. Do we have people like that?
Uh,
200,000.
Where we see that? 200,000 moving between cities, yes, and haven't taken up that new position. So 200,000. So now let's see. We make this 200,000. Right. And so what do we get?
Yeah. 0.0416.
You got 0.0
416.
416. All right. And when you multiply by 100, you got
4.16%.
4.16%. Right. Everybody happy with 4.16%? All right, fine. So what else are we going to ask for? Structural unemployment rate. So let me fix the 4,800,000. All right, I do my part. In fact, while I'm here, let me do my part again. Come on. 4,800,000. All right, so now structurally unemployment rate. So let's go, what do we mean by structurally unemployed here? This is our hardcore unemployment. We were just talking about them and we said that was what? Was that the 100,000 need to go back to school?
Yes.
All right. So 100,000 need to go back to school. All right, fine. 100,000 need to go back to school. And what do we get for that calculation?
0.020.
0.020. And when we convert that to a percentage, we get what?
2.08%.
Come on. 2.08. All right, fine. All right, so let's see. The way we would double check to make sure our answer is right. You see what our unemployment rate is, 20.83%. When we add up all of our various types of unemployment, it should total up to 20.83%. We said there are 1 million people who are unemployed, right? You have some who are structurally unemployed, some who is frictionally unemployed, some who is cyclically unemployed, some who's frictionally unemployed. So when you add up all of that together, it should come up to 100,000 people, and it should come up to 20.83%. So again, somebody calculate 14.58% plus 4.16%. Mr. Miko?
Sorry, go back again. 14.58%, 4.16%, 2.08%.
Yes.
I get 20.8.
Sorry?
I get 20.82.
Okay, so we did some rounding somewhere. So let's find out where we did the rounding.
Okay, let's go back then.
All right, 100,000 divided by 4,800,000. Go to 4 decimal places.
I get
0.02.
8408.
Okay, so, all right, fine. Frictional unemployment rate, 0.0416 what?
Pardon me? Which one are we doing? The
Number
200,000?
4.
Okay,
Mhm.
200,000 divided by the 4.4. I get 0.0416.
What's after the 6?
6.
There's another 6.
6. Yeah, 0.04166666.
Oh,
Then
see, that's the issue right there. This is supposed to be 7 then. Because the 6 would change the other 6 to a 7.
Did you just tell us you don't want us round off?
No, I understand what we're saying. Your answer is 6 going indefinitely, right?
Yeah.
So you cannot put an indefinite number of 6s after in your answer, right? But 1/6 is not as close to a correct answer as 166. And 167 is closer to 166 than 160. You know what? Don't worry about it. 4.17 is the correct answer here. If you
Okay.
give me 4.16, I probably would have let it slide. But the correct answer here is 4.17, because
Okay.
at some point when you have an indefinite series of numbers at the end, an infinite series, and the number in that infinite series is greater than 5, you have to do that last rounding. There's no getting around it. Okay, so now let's try it again. 14.58, 4.17, 2.08.
I get 20.83.
Bingo. All right. It's just a way of double checking your answer. Okay, so what about our discouraged workers? Right. We say the calculation is discouraged workers divided by labor force. What is our definition of a discouraged worker? Let's go back to our notes. A discouraged worker, we said, is someone who looked for work in the recent past, but gave up due to lack of opportunity. Let's go to our scenario, see if anyone fits that description. They looked for job sometime in the past, but gave up.
Is it 250?
So let's see. A further 250 have given up and are simply awaiting better economic times. Exactly. So here's your 250. So let's see. 250. All right. And what is our calculation for the rate of discouraged workers compared to the labor force?
0.0520.
0.0520 and multiply that by 100 and we get what?
5.20%.
5.20%.
Fine.
Okay. All right. And I'm assuming we don't have any dissenting voices. And lastly, underemployment rate. It's the underemployed divided by the labor force. All right, so let's see how we're defining those who are underemployed. Underemployed is someone who is working part-time, but would work full-time if they could, or someone who has a job that's well below their capabilities. All right, let's see from our scenario if we can find somebody who matches that description.
Is it the 300,000?
There are 300,000 persons working part-time and who would like to work full-time if they were able. That sounds about right. So let's put our 300,000 in. And what do we get?
0.0625.
0.0625, which works out to what?
6.25%.
6.25%. And that's it. Oh, too many percentages. That's all there is to it. So for your upcoming homework, you will get a full set of tables with, sorry, not tables. Oops, let me bring it back up. Where are we? Where are we? Okay. You would get something like this. All right. And you'll be asked to calculate it. You given these 7 questions. All right. And you would need to go through this exercise to get the answers for those 7 questions. Then you will be given this kind of scenario, and you'll be given these 7 questions. So in total, you'll have 18 questions. I'm sorry, 14 questions. And that you would need to cover. All right. And this is the kind of answer you would provide. You don't necessarily have to give me all this information. If you just give me the percentage, that's fine. But sometimes I like to see the whole thing, so I know that if something goes wrong, I can see where you went wrong. Yeah,
Can you go on the next page, please?
sure. And of course, the class is all being recorded, so you can always go on their YouTube page, and review the class. Yeah, sometimes it's clearer the second time around. So, questions before we move on? Good. All right. And the last issue that we're going to consider in this section is the inflation issue. Now, we need some clarity in definitions. All right. What economists and the rest of the world call inflation, Bahamians tend to call cost of living. Let's make sure we get those two answers, those two concepts correct, so we don't have to go through that anymore. Okay, so inflation, it very specifically is the rate of change of prices, all prices, over a defined period. Usually a month, we can measure it monthly, quarterly, or over the course of a year. All right, inflation is the rate of change of all prices in the economy over a defined period, usually a month, a quarter, or a year. And in the Bahamas, inflation is measured using the All Bahamas Retail Price Index, or RPI. But you may also see it as a CPI, Consumer Price Index. Both are used interchangeably, and both means exactly the same thing. That's inflation. So when you see or hear about the inflation rate, that's what we're talking about. Change in price, the change is the rate of change of all prices. On the other hand, and the RPI, CPI is produced by the Department of Statistics. Now, the Department of Statistics also produces what is called the Cost of Living Index. But the Cost of Living Index only indicates the change in the prices of a fixed basket of goods, right, that the department has determined an average Bahamian family they consume. So when you hear talk about the cost of living, technically speaking, they're only talking about the change in price of this basket of goods that they think the average consumer, Bahamian consumer, would buy. All right. These items, what are commonly known as breadbasket items or price control items. These are the things that are in this basket that is used to calculate the consumer price index. Here's the problem. Items in that basket are very rarely consumed by most of us. Give you an example. Included in this basket of items would be toilet paper. No, not the kind of toilet paper that you use every day, but single ply white cotton toilet paper. You know, single ply, the kind of stuff you can almost see through. Single ply. It ain't got no aloe, no crinkles, nothing to wipe your behind clean. It ain't got no good scent, none of that. All right, it's just single ply white toilet paper. You go in the food store, you probably could pick it up for about 49 cents a roll. Things may have changed since last time I looked. It may be up to 56 cents. It's a price control item. None of us buys that. All right. You buy that, man, you don't really got no choice. And you're desperate because you know to use it, you're gonna use half of that, in one sitting. Also including things like that would be white Wonder bread, regular sized loaf of white Wonder bread. Very few of us these days purchase and use regular size loaf of white Wonder bread. We wheat bread, and then there is a million different varieties of bread, but regular white Wonder bread, not so much. You begin to get the idea. Pigeon peas, canned pigeon peas. I think it's Sawyer's maybe. Right. Carnation evaporated milk is in there. Some baby diapers, I don't remember. But you see what we're talking about. You have a cost, what Bahamians like to call cost of living, but it's not really so, because this cost of living index, this is the bread basket items, are not items that too many Bahamians, only the poorest of Bahamians would tend to consume on a regular basis, items in this basket. So it doesn't really affect us. That's why we should be much more concerned about the inflation and using those terms as opposed to talking about cost of living. Okay. So the retail price index published by the Department of Statistics takes a much more comprehensive look at all prices prevailing in the economy compared to, say, the cost of living index. As such, most economists in and out of the Bahamas prefer to look at the inflation index as opposed to the cost of living index. All right, so the cost of living index, the RPI, is what is called a weighted index. A weighted index just means that each item consumed by Bahamians is assigned one of 12 categories, depending on how important, start again. Each item consumed by Bahamians is assigned to one of 12 categories, and each item has a weight based on its importance to that category. In addition, each of the categories also carries its own weight based on its importance to the overall economy. This, I'm hoping you can see this, comes straight out of Central Bank's regular publication. And this one is 2020, but I could have pulled this out of, February 2022 or May 2022. It would look pretty much the same way. The numbers may be changed, but the table is exactly the same. Right here, this is what the index looked like, a weighted index. So first of all, you see each index, food and non-alcoholic beverages is a category. Alcoholic beverages, tobacco, and narcotics is a category. Narcotics just means cigarettes and cigars, and sort of the vape products. Clothing and footwear, it's different category. Housing, water, gas, electricity, and other fuels, et cetera, et cetera. Right. So these are all the categories. You would notice that there is a number in bold attached to each category, a weight attached to each category. So you have the highest category weight is housing, water, gas, electricity, and other fuels. All right. This saying that this category changes, if there's a change in the price of items in this category, it's going to affect the economy on each of us a lot more than if there's a change in the price in some other category. So clearly, if housing, right, if there is an increase in either your rent or your mortgage, it's a big issue for us, for you. Is there an increase in electricity costs? Big issue for you. Increase in gas, other fuels, big issue, all right? So you can see why this category is so important. Also, of course, you would expect the food category to also be important. Transportation would be important because of the cost of gasoline. When you look at the household category, that gas is cooking gas, all right, LP gas, whereas the transport category would include the price of gasoline and diesel fuels. So you can see why that would be important. The lowest category would obviously be alcohol, beverages, tobacco, and narcotics, because the price of those can go through the roof, and only somebody who is hooked on the liquor or hooked on the tobacco, they're the ones going to be most affected. The rest of us, price go down high, we suck our teeth, say forget it, right, and move on. Right. So that category is the least important. Similarly, communications. All right. And communications more so because the cost of communication is relatively low. All right. But SMS messages are now what? Free? Or maybe what? A penny a text or something like that? I don't remember. It's very low. And you can keep and even calls, both long distance calls, the costs have gone down considerably. I remember a time when the roaming fees from DTC was just abominable. So here's the weight for each category. Now, each item in the category has a weight in and of itself, depending on how important it is to that category. So if we're looking at the housing, water, gas, electricity, and other fuels category, clearly rent and or mortgage cost would be a huge issue within that category. If you look at, say, I don't know, education category, tuition or school fee, if you will, it'd probably be a bigger item in that category as opposed to, let's say, PE clothes. Right. So that's what we're talking about. So when we're talking about a weighted index, we're saying each category carries its own weight, its own power in terms of how important it is to the economy. And within each category, each item in that category carries a weight depending on how important it is to that category. Questions? Okay.
Yeah, is the weight calculated in any units or it's just flat rate? I mean, weight, sorry.
Right. Right. There is no, I know there's no units in terms of, say, percentage. That's what you're talking about. No, because these are weights, there's no unit attached. So, but what we can say though, is if you're saying the total weights of all categories added up to 1,000, you certainly can work out the percentage. If you say, for example, miscellaneous goods and services, you do 145.64 divided by 1,000, and you get 14.564% kind of thing. You can do that. Yeah.
Okay. Oh, yeah. Okay.
All right. Okay. So that is as far as we want to go in terms of the big item, ideas about economics. And what we want to begin now is start really focusing our attention on the kind of things that we're going to need for policy. A lot of what we've talked about at this point is sort of building up our vocabulary so we can have a meaningful discussion about some of the policy issues. How do we address these policy issues? First, how is it done classically in terms of, what is the literature saying? What is the textbook saying? And then how does that match up with the reality of what we see in our day-to-day existence in this particular economy? So we're going to start off with looking at, generally speaking, how does any economy operate in the long run? What we call classical economics. And then we're going to look at what is called Keynesian, and it's pronounced like sugar cane, Keynesian economics, which looks at short-run economics, or what happens when an economy is in crisis. What happens if you're away from equilibrium? How do you get back there? How do you get, for example, if you have a significant amount of unemployment in your economy, that means you're away from equilibrium, because in that case, equilibrium would be everybody working, would be full employment. also then we will look at then, okay, so how is an economy developed in the short run? When we talk about capital markets, labor markets, then we can talk about policies. All right, that's what we're going to focus our attention on. So I do want to make sure that we don't have any more questions, but because I do not want to start this again until Wednesday. So, any questions about the upcoming homework? Any questions about the things that we have discussed today?
When you say we got midterm,
A week from Wednesday.
so not next week Wednesday. Oh, what? Not this
Yes,
Wednesday, next week Wednesday?
Yes. Is that
Serious?
a problem?
I need at least 10 days to catch myself. 10 days?
Yes, it is. It's exactly 10 days.
I need at least 14 days to catch myself.
You don't have 14 days. That being said, your midterm exam is a week from Wednesday. We will discuss that more next Monday. All right. All right, folks, if there is nothing else, I want to thank you all very much, and I will see you guys on Wednesday. And I'm assuming everybody is handed in their homework for this week.
Okay. Good
All right.
evening, everyone.
Take care, everyone.
Bye.
Good night.